Equity valuation. Valuation of equity shares. Models for valuation of equity shares. Two models. Dividend-based model, earning-based model. Dividend-based model. Perpetual dividend with constant growth assumption. Dividend growth model, which is based on Gordon's growth model. Here, perpetual dividend with constant growth assumption will be used. V0 equals to D1 by KE minus G, where D1 is the expected dividend per share at the end of first year. D1 equals to D0 into 1 plus G. D0, dividend paid by the company recently. G means growth rate. How to calculate G? B into R. B is the retention ratio, R a return on equity. K equals to required rate of return or expected rate of return of the investors on equity shares or cost of equity. V0 equals to intrinsic value of the share or equilibrium price or fair price or theoretical price of the share. Two-stage dividend discount model. Perpetual dividend with variable growth assumption will be there in case of two-stage dividend discount model. How to calculate V0? Value of the share equals to present value of uneven dividends for certain period. That is, calculate present value of discrete value using table. Calculate present value of the discrete value using table. Add present value of perpetual dividend. That is, calculate present value of terminal value. By adding this both, we will get the value of the share. If share is held for limited purpose assumption, how to calculate V0? Value of the share, present value of uneven dividends for certain period. That is, calculate present value of discrete value using table. Add present value of the price expected to be received on sale of share. We will get the value of the share V0. If question is silent regarding whether dividend is D1 or D0, assume D0 in following cases. If in the question it was given that dividend is paid or dividend pays or dividend for the year in income statement is given, it is considered as D0, otherwise D1. Decision making on the basis of intrinsic value of the share. If intrinsic value is greater than equals to current market price, buy the share. If intrinsic value is less than current market price per share, sell the share. Calculation of KE using dividend discount model. In case of perpetual dividend with constant growth assumption, K equals to D1 by P0 into 100 plus G, where P0 equals to or P0 equals to current market price. In all other cases, K is calculated using trial and error method. That is, a rate at which present value of future cash flows. Rate at which present value of future cash flows equals to current market price P0. Formula for interpolation. Lower rate plus value at lower rate minus required value divided by value at lower rate minus lower at higher rate. Lower value at higher rate into higher rate minus lower rate. Higher rate minus lower rate. This is the formula for calculating interpolation. Dividend discount model. Intrinsic value of the share P0 equals to how to calculate intrinsic value of the share using dividend discount model. Present value of all future dividends discounted at required rate of return will give intrinsic value of the share P0. If intrinsic value of the share is more than current market price, bond is underpriced, purchase it. If intrinsic value of the share is less than current market price, bond is overpriced, do not purchase. Multi-period discount model. Intrinsic value equals to D1 by 1 plus KE whole to the power 1 plus D2 by 1 plus KE whole to the power 2, so on, DN plus PN divided by 1 plus KE whole to the power N. Infinite period dividend discount model. No growth model. This method is used when there is no retention earnings. Return earnings, that is, all earnings are distributed as dividend. That means the dividend payout ratio is 100%. We use infinite period dividend discount model, no growth model. In such a case, P0 equals to DPS divided by KE. Another way for calculating P0 equals to D1 by KE minus G. K equals to D1 by P0 plus G as per single growth model. As per Walter's model, P0 equals to D1 by KE plus E minus D into return on equity divided by KE into KE. E means equity, D means debt. How to calculate G? G equals to B into R. EPS equals to book value per share into return on equity. Earnings growth model. As per earnings growth model, P0 equals to EPS into 1 plus G divided by KE minus G or E1 divided by KE minus G. K equals to R plus beta into R minus RF. How to calculate assets turnover ratio? Assets turnover ratio equals to turnover divided by total assets. Next, portfolio management. Portfolio management deals with construction of portfolio, whereas security analysis deals with analysis of individual stock or bonds. Fundamental analysis are used to calculate intrinsic value of the stock, used for long-term purpose. Technical analysis is used for short-term purpose. It is done through study of past price trends. Realized yield R equals to nth root of summation of 1 plus RV divided by P minus 1. R equals to square root of nth root of summation of 1 plus RV divided by P minus 1. It assumes cash flows will receive at the end. Forward rates 1 plus YTM whole square equals to 1 plus R1 into 1 plus R2. 1 plus YTM whole cube equals to 1 plus R1 into 1 plus R2 into 1 plus R3. These are the ways to calculate forward rates. Other important points. In case of distressed companies, value of equity equals to discounted cash flow value of equity into 1 minus probability of distress plus distress sale value of the equity into probability of distress. Value of a call option C0 equals to S0 into delta minus cash inflow divided by 1 plus R. This is another formula for calculating the value of call option. Pharma net selectivity model. Alpha equals to RP minus KE. KE is the R of KE. How to calculate KE? RF plus beta into R minus RF. RP means return of portfolio. KE cost of equity. KE can be calculated by using CAPM model. RF plus beta into R minus RF. Alpha equals to RP minus KE. It is divided into two categories. RP minus critical market line. Second way is critical market line minus securities market line. RP minus critical market line is used for, it is the profit paid for skill used by the fund manager. Critical market line minus securities market line is to compensate for compensation paid for bearing high risk. Compensation paid for bearing high risk, or it is the return due to higher risk. So, in case of pharma, net selectivity model, alpha equals to RP minus KE. It is divided into two categories, RP minus critical market line and critical market line less securities market line. Critical market line minus securities market line is for the compensation for bearing higher risk. Compensation paid for bearing higher risk or return due to bearing higher risk.